So welcome to tonight's session, Math 3702. We'll be covering valuations tonight. The question we'll be covering is that of the October-November 2020 final exam. So we'll work through that question paper for the valuations part. And then for the next 2 weeks, we won't have class. If you look at the schedule, we won't have class for the next 2 weeks. So next week, we won't have a class. And the following week, we won't have a class. Then we'll resume. So during this 2 weeks, you're going to do aspects of the October-November 2020 exam paper. I will tell you which sections you must do at the end of the lesson. So tonight we're going to get into valuations. So just to give you a brief overview. So just give you a brief overview on valuations. For your purposes, you're going to need to know 4 valuations. Number 1, it is going to be free cash flows. Number 2, it will be earnings multiple. The earnings multiple is made up of 2, the earnings yield and the price earnings. You will have to know the dividend growth model, and you will have to know the net asset value method. Okay, so those are going to be the 4 valuation models you will need to know. Valuation is a significant topic. It's a big topic within financial management. So whether you actually get to use it often in the real world, it depends on the job role that you have, but it's the principles of valuations that is going to help you to learn what they want you to learn. And then obviously in the real world, it does get used extensively depending which role you, what job you take up. So for example, you may use valuations as a financial accountant. If your companies have a complex, if you work for a business that have lots of acquisitions and so forth, then you may come across where you have to perform a valuation as a financial manager, or when you prepare financial statements. When you have an acquisition, you're going to have to do an impairment analysis. And when we do an impairment analysis, we apply valuation models. Okay, so that is important. Also, if you are, if you're a financial accountant or a financial manager, and you have lots of complex accounting issues. So for example, you may have financial instruments, and various aspects. So and your company applies IFRS 13, which is fair value, quite extensively. Then you also need to know valuations. So valuations play a big role in financial accounting, depending on how complex or the complex transactions that the company is exposed to. As an auditor, if you're auditing a company that has complex transactions, then you'll need to be able to audit those valuations. Generally, when a company has complex transactions and complex valuations, the auditor itself do not do the audit. They get the corporate finance team of the audit company to do the to analyze the valuation and give them a report. So when you study auditing, you will see there's a section called when you outsource to experts. So the expert could either be in-house, or it could be someone completely third party, where they will do the work for you, and then you just have to audit their work, which is perhaps a specialized area. But basically, ultimately, you still need to perform a valuation. Typically, the audit team will do a valuation when you are analyzing impairment. But when you have to analyze a valuation when there is a merger and acquisition for goodwill purposes or something of that nature, they generally just get their specialized team. So as you can see, valuations play a big role in financial accounting if you are working for a company that has complex transactions. Then as an auditor, if you're auditing a company that has complex transactions. And then finally, if you go into investments, if you want to become an equity analyst, then your job is to do valuations. Sorry. then your job is going to be to do valuations. Over and above that, valuations have lots of principles and concepts that is important for you and I to know as an accountant or as a finance manager. So therefore, this section plays a significant role. So now there's going to be various techniques we must be able to do. So like in CTA, there's about 6 or 7. For our purposes, for undergrad, you need to know 4. So number 1, it is free cash, in no particular order, but number 1, free cash flow. And the free cash flow that we do in undergrad is a very basic one. When you go to CTA, then you do the real free cash flows. The second is a dividend growth model. We have already covered dividend growth model when we covered WACC. The third is an earnings multiple. Now, there are various types of earnings multiples. If you must pick up a textbook, you will find many, many earnings multiples. But the typical one that we will do is the price earnings multiple, the PE multiple. With the PE multiple, you could get the earnings yield, because the earnings yield is the inverse of the price earnings multiple. And then number 4, it is the net asset value method. The net asset value method is very simple. It's like a 5-marker, but we will go through each of those, and then we're going to cover a question. The question we're going to cover is going to deal with both free cash flows as well as PE multiple. Okay. So when it comes to valuation, so for example, if you must look at an equity analyst report, if you can find one, it's not necessarily very easy to find one because it's generally confidential, but sometimes you will find one. Maybe if you Google equity analyst report Morningstar, they may have some free ones available, okay? Then you can see how it look. What you will see on the first page, they will have a summary. I can't remember what they call it, but it's a summary that when you hand it over to the investment committee or to the portfolio manager, because remember the equity analyst does all the research and they provide a recommendation. The portfolio manager that actually selects the stocks and actually decide what how to make up the portfolio, they will analyze and read the investment report or the equity analyst report. And the first page is basically a summary of what the report is about. I'll give you like the company name, the price, the fair value, the valuation that you actually obtained, and so forth. And one of the things over there in that is you will mention which valuation method you have used. So in that summary, you will mention which valuation method you have used. Earnings multiple, free cash flow, dividend growth, whatever, okay? Then after that first page, after that summary, it's literally like, I think it's a half a page. After that summary, you will then give your report. And basically in the first, I think probably in the first paragraph of that report, or the second section in that report, you will discuss which valuation method you have used and why you have used it. So the first thing they want to see is so now they know what valuation you used because you mentioned, then you need to explain to them why the valuation method that you have selected is appropriate. So we have the free cash flow, we have the dividend growth model, and we have the earnings multiple. I'm not going to refer to it. I'm not going to say the earnings multiple. I'm going to say the PE multiple, because there are different types of earnings multiples. And we are going to be focusing on the PE multiple. So you will have to explain to them, you will have to tell them why the valuation method you have used is appropriate. Now, when you study CFA, they will tell you when to use which method. So I'll give you a high-level overview of when to use which method. So the free cash flow method will generally be used if you acquiring a majority interest. So when you acquiring more than 50%, it is basically a majority interest, and then you will use An appropriate valuation method would be the free cash flow method. Another appropriate method that you could use when you are dealing with a how can I say now, when you're acquiring a majority interest, is the PE multiple. So when you have a majority interest, when you're acquiring a majority interest, the two appropriate valuation models would be the free cash flow and also the PE multiple. However, the PE multiple generally gets used when you are trying to perform evaluation for a private company, a company that is not listed. So when you see a company that is not listed on the JSE, and you're acquiring a majority interest, you will most likely use the PE multiple. If it is a listed company and you're acquiring a majority interest, you'll most likely use a free cash flow. But basically, you use the PE multiple or the free cash flow if you are acquiring a majority interest. Okay? And then more specifically, you will typically use a PE multiple when you are valuing a private company. So when you see PTY Ltd, PTY Ltd implies it is a private company, then you will most likely use a the PE multiple. Okay, so that's important to take note. Then for the dividend growth model, you will generally use the dividend growth model if you are acquiring a minority interest, less than 50%. So why? So when you're acquiring a majority interest, you as the acquiring company will be able to affect the cash flows. You as the acquiring company will be able to affect the earnings. And as a result, because you will have control over the cash flows that you generate, and you will have control of the earnings that you generate, it makes sense that you use the free cash flow method or the PE multiple method. However, if you have a minority interest, you basically won't be able to effect any cash flows because you have no say. You won't be able to make the decisions. So as a result, the only benefit that you have from investing in a company is the dividends you receive. So your value, the value to you is basically based on the dividends that you will receive. And as a result, you will use the dividend growth model. So just think about that. If you are if you acquire a controlling interest, think about financial reporting. You have a subsidiary. That means you have the ability to make the necessary decisions regarding revenues, expenses, financing, all of those type of stuff. All of those important decisions you have control over, which will ultimately impact, which will ultimately affect the revenues you generate, the cash flows you generate, and so forth. So as a result, that's why it makes sense to use the free cash flow method. Or similarly, that's why it makes sense to use the PE multiple. But if you have a minority interest, you have no say over the decision making. You can't control what financing the company has. You can't control the business they generate, the new products they issue. You have no control over that. You have no say because you're minor. The only benefit then that you have from the company is the dividends. So therefore, the value to you, the value of your investment would be based on the dividends that you receive. And that is why the dividend growth model would be appropriate. Now, in most cases, they will tell you that a majority evaluation is generally performed assuming a minority interest. Now, in the real world, the free cash flow method does not get used that often. So the free cash flow method does not get used that often. The reason being is it's because the free cash flow method involves forecasting financial statements, and as a result, forecasting adds additional risk. So therefore, many investment analysts don't use a free cash flow. I've hardly seen them use a free cash flow. Well, I'm not very much involved in investment analysts, but the people that I speak to, they hardly use the free cash flow method. And I asked them why, and they said it's because of the risk of forecasting. But nonetheless, it is still an appropriate valuation model. The valuation model that they use often is dividend growth model and an earnings multiple. So, because all they have to do is estimate earnings, and generally asset managers, they will use financial statements, but they have the additional benefit of being able to speak with management. So then they will, sometimes they perform a valuation, they send the valuation to the CFO of the company, and the CFO of the company will analyze it and tell them where there's some errors, or what not necessarily errors, but in terms of the assumptions and so forth. So depending on how the relationships are, that is why investment analyst tries to establish very good relationships with the management of companies, because then they will be able to imagine you send your valuation to the CFO. So I know the one company, um, the one analyst prepared a valuation, sent it to obviously the line manager, the investment head, and the investment head has a relationship with the CFO of Woolworths, and he basically sends his valuation to the CFO of Woolworths, and they will check it for him, and then they will send it back. So you see, they have some further insights. So they will generally use an earnings multiple, like the EBITDA or perhaps a PE multiple, but generally they will use an EBITDA multiple to do a valuation. If you don't necessarily have that relationships, then the other valuation model that they use often is the dividend growth model. You can only use a dividend growth model um, if two conditions hold. Number one, there is a long history of dividends. So a long history of unbroken dividends. So you use a dividend growth model if there is a long unbroken history of dividends. And a long unbroken history is between 10 to 15 years. So if you can go 10 to 15 years and there was a dividend every single year for the last 10 to 15 years, that is a long history of unbroken dividends. That's number one. The second, it must be predictable. Okay, so there must be a dividend policy. So for example, if you pick up ShopRite, I think ShopRite's dividends runs for the last 20 years, right? So they have an unbroken dividend for the last, I think 20 years. So if you just go back on their financial statements, you can even just do it for the last 5 years and you will see that they had a dividend every year. Then what you will also have a look at is whether you can predict the dividends, meaning there's a constant dividend payout. So there's a dividend policy. So for example, ShopRite's dividend cover is 2. What is dividend cover? Dividend cover equals earnings per share divided by dividends per share. So if you take ShopRite's earnings, so total earnings divided by total dividends each year, or you take the earnings per share divided by dividends per share each year, you're going to get 2. It's gonna, like I did it, I think 2 years ago I did it for about 5 years. It was like 2.01, whatever, but it's basically 2. So there you see, there is a long history of unbroken dividends, and every year basically it is 2. So now you know you can use the dividend growth model because the criteria is met. So so now you'll be able to get evaluation. Because remember, a dividend growth model is running into perpetuity. So the only way you can assume that the dividend will be into perpetuity if there was a history of dividends. So then you can analyze how the company pays a dividend and so forth. So that will give you a good basis to assume going forward into the future that they will have a constant dividend. Okay, so just take note of that. Another reason where you can use the dividend growth model is not necessarily the dividend growth model. You're just applying the principles of the dividend growth model is in a property company or a company that has recurring revenue. So for example, a property company earns constant rental income. Every month they'll get rental income, or every year they'll get rental income. So that is like a recurring income. So then you will use the perpetuity formula, which follows basically like the dividend growth model. So remember, the dividend growth model says value equals D1, dividends of the next period, divided by cost of equity minus growth. Now, the same thing you can apply for the rental income. The dividend is basically the rental income divided by whatever the capitalization rate of the property is, and then there's a growth rate. Now, remember, the growth rate would be that every year a company would a property company increases their rent, so you can get an average of the increase. So those are basically circumstances when the dividend growth model makes sense. So just take note of that. So what you need to know now, when do you use a free cash flow? When do you use an earnings multiple? When do you use a dividend growth model? So for the dividend growth model, you will generally use if there is if you're working out a minority. In the real world, they don't really care about minority majority. They will just have a look. The dividend growth model gives you an unbroken history, and can you determine the dividends? Because remember, with Shoprite, there's a constant dividend cover of two, and there's a history of dividends. So all they have to do is estimate the future earnings of Shoprite. Once they determine the future earnings of Shoprite, they will just work out dividends with using the dividend cover of 2, and then they can perform the valuation. So just be aware of that. Okay. But for our purposes, take note: free cash flow, PE multiple, majority, dividend growth, minority. But also when you use the dividend growth, those criteria needs to be in place. Generally for the PE multiple, we will use it when we are acquiring a majority interest and the company is a private company. Okay, so just take note of that. That is PE, that is free cash flow, and that is so that is PE, free cash flow, and dividend growth model. The fourth one is the net asset value. What you must understand, net asset value is an accounting number. What is that? Net asset value is equity. It is assets minus liabilities. Assets minus liabilities equals equity. Another term for equity is net asset value. So the way the NAV works is basically you take the equity of the company per the financial statements, or you take the assets minus liabilities of the company per the financial statements. Okay. But now remember, financial statements is past looking. Okay. It is based on historical information. In financial management, we are forward looking. So what we will do, we will start off with the net asset value of the financial statements. So this can either be equity or assets minus liabilities, depending what they give you. But remember, assets minus liabilities is the same thing as equity. So you can use any one. But the financial statement is based on book value. Financial management is all about market value. So what we will do is we will just adjust the net asset value for any market value adjustments. And that will give us the value using the net asset value method. What's very important, the net asset value method should not be used as your main valuation. It should only be used as a reasonability check. Okay, so in the real world, they do that. They do a dividend growth model. They do a PE multiple, or they do a free cash flow. And then as their reasonability check, they will do a net asset value, and they'll just have a look. So what they're trying to see, the value that we are getting, what premium or what discount is it trading at relative to the equity of the company, the net asset value of the company. So just take note of that. Okay, so it gets done in the real world, but it's not used as your main valuation. Okay, so that is basically valuations. We will now go straight into a question. You will see I sent you a question October, November. If you can open that, we will go to question 2. But before we do that, do you have any questions? Danielle, any questions from your side? Fahim, any questions?
No, no questions, Faiz.
Kayla, Kelsey? Lindo Kule, Pungani,
No question.
Mpo, any questions? Okay, so open up that question paper that that I sent you, October, November 2020. I'm just opening it my side. I'll tell you what you need to read, and then I'll read it with you afterwards. I'm just really opening it my side. Sorry, my PC is a bit slow. Okay, so we go to question 2. So we go to question 2. Where's question 2? So under question 2, all you need to read is the mergers and acquisitions up until the end. So just read mergers and acquisitions up until the end, and then I'll give you 5 minutes. So on question 2, from mergers and acquisition up until the end of the scenario. It's like basically is a page. Just let me know. Let me know once you're done reading. Just let me know once you're done reading. Either message me or just thumbs up. But I'll start in 2 minutes time if everybody's not yet done. Okay, I'm going to start reading now. I'm going to share my screen. So you should be able to see my screen. I'm going to read the scenario and we're going to go through it. I'm just going to read from mergers and acquisitions. But I think this is only relevant information. So the reads as follows. Two farms were identified for potential acquisition by SF Group. The farms were offered different payment methods for the purchase of the stake in the farms. Management is not certain which payment method will be best. Currently, SF Group has set the 12 million Rand cash and 13 million Rand marketable securities aside for mergers and acquisitions. The farm's details are as follows. Farm 1. The farm is currently owned by Jono, Carol, and Reese, with ownership in the ratio of 2:1:2. SF Group wants to make an offer to buy Jono and Reese's entire stake in the business. Farm 1 provides top quality innovative dairy products, butter, cheese, yogurt, and ice cream to the South African market at competitive prices, all while conducting business in a responsible, fair, and environmentally friendly manner. The competition is rife in the dairy farm products industry, and companies like Farm One struggle to penetrate the market due to limited distribution network and high marketing costs and branding costs. Nonetheless, high margins and relatively low production costs result in good profits for most dairy farming products. Listed dairy farming companies have an average earnings yield of 16.25%. A listed share is said to trade at 15% above an unlisted share due to its liquidity. Okay, so just take note of that. Okay, so let's have a look. So the important aspects is that SF wants to acquire Farm 1. Now, Farm 1 is an unlisted entity. Okay, so Farm 1 is an unlisted entity. So that's very important. Okay. When you use when you use a PE multiple, a private company won't have a PE multiple. The reason being is PE multiple is calculated as follows. PE equals share price divided by earnings per share. Now, in order to have a share price, you need to be trading on a stock exchange like the JSE. Now, a private company is not listed on a stock exchange, so therefore they won't have a share price. So as a result, they won't have a PE multiple, or at least they won't have a PE multiple that's readily available. So what would you do? You would use a comparable PE multiple from another listed company, and you will use that as a starting point. Then you will make the necessary adjustments for any differences. Okay, so just take note of that. Then you see you can see there's a marketability discount of 15%. We will have to take into account that discount for lack of marketability. Lack of marketability just means because you're not listed on a stock exchange, it is very difficult to trade the shares. You understand? Whereas with a public company, a company listed on the JSE, it's a little bit easier because there's a market where you can sell your shares if you feel like selling it. So that is why we will always take a discount. So typically the discount will be 10, 15%. They are using 15%, so we use 15%. So just take note of that. So most likely we will use a PE multiple. Why? It's we're acquiring a majority interest. How do we know we're acquiring a majority interest? They're splitting the ratio is 2:1:2. We want to buy the entire stake from the owners that have a ratio of 2. So basically we want to buy 4 out of the 5. So as a result, it's going to be a majority interest. So when you have a majority interest, you can either use PE multiple or you can use free cash flow. Based on the information, will be using the PE multiple because we are given information relating to comparable companies in that industry. Okay, so just take note of that. So the past 5 years earnings of Farm 1 are reported below. They're giving you the net profit. When you use the PE multiple, the valuation is calculated as follows. Value equals sustainable earnings or maintainable earnings multiplied by PE multiple. Okay. The PE multiple will be determined using a comparable company's PE multiple and then making the necessary adjustments for any differences between the comparable company and the target company. The target company being Farm 1. The earnings is not any earnings. It is a maintainable earnings or a sustainable earnings, meaning you want to work out an earnings that will most likely take place in the future. So how do we do that? We need to remove any once-off items. So you're going to see where once we read, there's going to be 1 or 2 one-off items that you'll have to adjust for. Once we adjust, we will get a new adjusted profit figure known as your maintainable profits. From there, we will have to decide which profit number we will be using. So you have one of 2 choices. Choice number 1, you either use the latest year's earnings number, so in this case 2019, or you use a weighted average of the 5 years. Now you need to know when to use the latest year and you need to know when to use a weighted average. So the way we'll use, so the way we'll do that is as follows. If there is a trend, an upward trend or a downward trend, then you will use the latest financial year. If there is no trend, the earnings is erratic. 1 year it's high, 2 years it's low, then again high, then again low. So there's no trend. It is erratic. Then you will use the weighted average. So just take note of that. Okay. So now we read on. Earnings reported in the 2018 financial year include an after-tax profit of 1.4 million rand made on the sale of a patent. Now you are trading in dairy products. The sale of a patent is not normal business. Okay, so it's not going to happen every single year. As a result, that is a once-off item. So we need to adjust the 2018 financial. We need to adjust the net profit of 2018 for that 1.4 million, so that we can get a maintainable earnings figure. Then they say during 2016, the longest serving managing director of Farm 1 resigned and was paid 1.35 million before tax for the restraint of trade imposed on him. So once again, what we will have to do, we'll have to adjust 2016's figure with that restraint of trade. Why? We're not going to be paying a restraint of trade every single year. So as a result, that is a once-off item. So we need to make that adjustment to get a maintainable figure. Then once we have the new adjusted figures, we then have a look whether there's a trend or not. If there is a trend, we use the latest financial year, 2019. If there is no trend, if it's erratic, if it goes up and down, then we will use a weighted average. Okay. So why will we use why will we use a PE multiple? Number one, we are acquiring a majority interest. I don't know. I'm just going to see quickly if there's some more information about the farms anywhere above. I don't know if there's I don't know if there's more information, but basically what we want to do. So so remember, when you will use a PE multiple, when you're acquiring a majority interest, and most likely when you are dealing with an unlisted entity. So you can make mention that this company is probably unlisted. I can't remember if I saw unlisted anyway, but you just make mention, and then that's why it is appropriate to use Farm 1, okay, to use a PE multiple. Now we go to Farm 2. So Farm 2, the company is currently owned in the ratio of 2:1 by the Sammy, Moon, and Mary Ross respectively. SF Group has made an offer to buy Sammy Moon's entire stake in the business. The profit of Farm 2 for the past 5 years are reported below. Once again, we're buying 2 out of the 1. So 2 out of 3 is 66%. So as a result, it is a majority interest. So therefore, once again, an appropriate valuation model will either be a free cash flow or a PE multiple. Okay. So there we have the net profit. And they say Farm 2 is forecasting 7.5%, 8%, 8.5% growth in the company's profit for the 2020, 2021, and 2022 financial years, respectively. In each forecasted year, a depreciation charge of 250,000 Rand will be maintained. The free cash flows of the entity approximates the farm's net profit after reversing non-cash income and expenses. You can assume the farm has no debt. So there, once again, you're acquiring a majority interest and you have the necessary information in order to use a free cash flow method, because you have the cash flows of the company. So just take a note of that. Okay, so therefore for Farm 2, we will use a free cash flow. So Farm 1, PE multiple, Y, as a majority interest, also dealing with an unlisted entity, and we have the necessary information in order to use a PE multiple. For Farm 2, we're also acquiring a majority interest, and we have the necessary information to use a free cash flow method. So therefore, we will do that. Okay, so remember, that's also a thing that you will do. Based on your criteria, you'll also have a look what information, what's the best information available that you have that will give you the best, the most accurate number or the most accurate result. And as a result, and therefore, you can make a decision on which method you will be using. And that's a typical thing that also gets used in the real world. But generally, asset managers do have enough information to use any evaluation method they have, because they have relationships with companies, so they can actually obtain further information. So additional information: SF Group will make an offer based on the following assumptions. Farm 2 acquires Sammy Moon's shares in Farm 2 in exchange for a stake in SF Group. SF Group will pay with shares for every one share held. SF Group will pay with shares for every one share held in Farm 2. With regards to Farm 2, the growth rate after 2022 will be at 5%, and the required rate of return is estimated at 17.25%. The general inflation rate is currently 6.25%. Okay, so let's just have a look how we will deal with this. Okay, I'm going to read the required, then I'm going to go into Excel and I'll perform the valuations. I'll show you the formulas for all 4 valuations, and then we will work through the specific valuations. So, number 1, calculate the weighted average cost of capital for SF Group Limited at 31 March 2020. That's going to be one of your homework for over the next 2 weeks. Okay, so remember, next week and the following week there's no class, but for undergrad, because we're busy, we will be dealing with test 2 preparation for CTA. As a result, we don't have undergrad classes during that time. What we will do, you will have this question paper to complete. I'll be start marking your papers from next week for those that submitted the last questions. I'm working through your submissions. So here you're going to do part 1 of question 2, calculate the WACC. Okay, but that is for the next 2 weeks. What we're going to deal with is number 2, not the entire number 2. Yeah, actually the entire number 2. So using the appropriate valuation methods, determine how much the farms are worth on 30th March 2020. That's very important. The date is very important. In financial management, you need a reference point. So the date is a reference point. The date is very important when it comes to capital budgeting, when it comes to sources of finance, when it comes to WACC, when it comes to valuations. Because each time you're working out a present value, you need to know what date you are busy with, because otherwise how are you going to know at which date you need to perform the calculations? So that is why they have to tell you the date. You don't have to guess. So the valuations is all going to be based as at 31 March 2020. So they say your solution must address the following. Number 1, what percentage shareholding will SF Group Limited purchase for each farm, Farm 1 and Farm 2? The way you work out the percentage is using those ratios. 2:1:2, and in the other one, 2:1. So I'll show you how to use those ratios in order to work out the percentages. Okay. Then you're going to discuss the different valuation methods and conclude which valuation methods should be used and why. So remember the different valuation methods: P multiple, dividend growth model, free cash flow. So we will be using dividend growth, we will be using free cash flow and P multiple. Why? We are acquiring a majority interest, and we have information available for those methods as well. So that's what you will just answer. Then you will then they'll say use the most suitable valuation method for each farm to determine their values. Okay, so that is what we will end up doing. So we'll be doing those 3 things. Number 4 we won't do, because when we discuss mergers and acquisitions, then I'll cover that aspect over there. Okay, so we'll do number 1, number 2, and number 3. So let's get straight into it. I'm gonna open up Excel. While I open up Excel, you can ask me any questions. It doesn't take some time to open up Excel. Does anyone have any questions in the meantime?
Yeah, Faiz, I didn't hear. What is the homework again?
I'll mention it again at the end.
Okay.
Okay, so remember that the required is straightforward. Okay, so there's nothing tricky about the required. The required number one asks you to do valuations as at 31 March 2020, and then they broke it down. In the first one, you must discuss what percentage you're going to be acquiring. So there's nothing tricky about that. It's crystal clear what needs to be made, what needs to be done. Number two, they're also very clear in saying, tell them which methods are available and which methods you will be using. And then number three, they're telling you now, based on the method you have selected, perform the valuation. So I'm going to share my screen. You should be able to see Excel. Okay, so we first going to work through the required, and then I'll take you through the different other valuation methods. So just tell me if you see Excel. You should be able to see Excel. Okay, so I'm assuming you can see Excel. So now we're going to do number one. Okay, so question two. So this is October, November 2020. Okay. MAC 3702, October, November 2020. Question two. Okay. So we're going to do 2.I. So 2.I, so if we go back to the required, it says, using appropriate valuation method, determine how much the farms are worth on 31 March 2020. So they're telling you, you need to, that you need to determine how much they are worth. But now remember, yeah, as you can see, like I told you, whenever you do a valuation, one of the most important aspects that you need to discuss is which valuation method is appropriate. So that is what point two is asking from you. Okay. And then number three is saying you now calculate the value of the farms. Okay, so that's very important. So let's do number one. What is the percentage? So for farm one, so here we have farm one. So remember the ratio is 2:1. If we just take those people quickly. So it is Jono, Carol, Reese. Jono, Carol, Reese. So we have Jono, Carol, and Reese. Okay. The ratio is 2:1:2. Okay. So if you work out the total, where's this total here? So if you work out the total, this adds up to 5. So 5 is the 100%. So basically Jono's percentage, so this is ratio. So we have detail, owner, we have ratio, and then we can work out the percentage. Okay. So Jono's percentage is his ratio divided by the total pie. So the pie is cut into 5 pieces. Jono has 2 pieces. So divided by 5, so he has 40%. Carol has 1 piece of the pie, and there are 5 pieces, so she has 20%. Reese also have 2 pieces out of a 5-piece pie, So therefore, this person also has 5. So therefore, it'll add up to the 1. So our percentage is basically Jono plus Reese. So SF percentage is 80%. Okay, so 40% plus 40% is 80%. Are we happy with that? You can change this to the percentage if you want. So there we go. Okay, so that is Farm 1's ratio. Farm 2, similar. And I'm just going you I'm taking a long route so you can see the full workings, how I exactly do it, but you can work it out much simpler. Okay, but remember it's only 2 marks, I think. So Farm 2, who's the owner? I think it was Sammy and someone else. Sammy and Mary. So Sammy, Mary, nothing over here. 2 is to 1, and there we go, 67. So SF percentage is 67. Okay, so therefore it is all of both of them is a majority. So that is answering 2.1. 2.2, so you can see that one is 3 marks, right? So must work out very quickly. So all you could have done is basically just say, all you could have done is just do that, do this, and then say, you don't have to just write down the names and stuff. You're just saying you're acquiring 2 out of 5 plus 2 out of 5. What does that equal? Similarly, you're acquiring 2 out of 3. What does that equal? Okay, and you get your percentage. But systematically, this is going to be, so for example, if you must present this to something, this makes a lot more sense. So if a board of director want to look at this, they exactly know what you are talking about. Okay. Now we're going to go 2.2. So 2.2 is asking you, discuss the different valuation methods and conclude which valuation method should be used and why. Okay, so the different valuation methods. So we have free cash flow. We have PE, or you can say earnings multiple, i.e. example PE, dividend growth, and what was the other one? Net asset value. Okay, so applicable for a majority interest, and if applicable when acquiring, a majority interest, and if cash flow, and if future cash flow information is available. Okay. Earnings multiple, example PE, applicable when acquiring majority interest, and if future earnings information is available. Okay, typically used when the target company is a private company. Okay, when the target company is a private company. Okay, so those are reasons. Dividend growth model applicable when acquiring a minority interest. There is and there is a history of unbroken and there is a history of unbroken dividend payments and a dividend policy, so that it is predictable, predictable as to the dividend payout. Okay, so that's what I discussed during the lesson. I'm just putting in words in this question. So remember, the free cash flow is applicable for majority interest. The earnings multiple is applicable for a majority interest and is generally used when your target company is a private company. The target company refers to the company that is being bought, okay, that is being acquired. So that's typically used for a private company. The dividend growth model is typically used when you're acquiring a minority interest and if there's a history of unbroken dividends and there's a dividend policy. What we mean by dividend policy is you exactly know what the dividends will be once you have a certain number. Okay, so if you have earnings, you know dividends will be half of earnings, stuff like that. Okay, so just remember you need that, because otherwise the dividends is useless. Okay, net asset value. I'm not going to actually put down the net asset value. Okay, we can just say only used as a reasonability check, not used as the main valuation method. Okay, so just take note of that. That should be final. So we will say form 1, we're going to use PE multiple. Why? It is, we will use PE multiple. Why? Majority interest. Okay. Earnings info available. Earnings and PE info available. Okay, so we have that. Form 2, what are we gonna say? Free cash flow. Why? Majority interest. Okay, cash flow info available. That's the reasoning. Okay, so just take note of that. So you need to know your different valuation methods, when you can use them. Okay, then given a particular question, you must be able to identify which method is appropriate. Then, in some cases, like in CTA, for example, they will generally tell you which method they want. So sometimes they will tell you which method to use, sometimes they will not tell you, and you must use the information available to determine which method is the appropriate method. Remember, in the real world, that is what's going to happen. You will have to determine which method is an appropriate method, particularly if you're going to the investment space. Okay, like I said, in the investment space, if you just try to Google an equity analyst report, maybe put in Morningstar, you may find one. One of the things they're going to discuss is the valuation method and the appropriate use thereof. Why that method is the appropriate method. So very important. Okay, which method? So know your valuation methods and know when to use them. Okay, now we're going to go into the big one. Okay, so I'm going to just change this to I and 2i, and 2i. I'm going to do 2.3 over here. So 2.I. Okay. So now we're going to do the valuation method. So for PE multiple, it will be as follows. Okay. Value equals PE multiplied by maintainable earnings. Another word for maintainable is sustainable. Doesn't matter which one, same thing. Okay, so now so what do we need? We need the PE multiple. We need sustainable earnings. We need maintainable earnings. And that's going to give us our value. Okay, so just take note. Understand the following. Why do we use a maintainable earnings? We're trying to predict the value of the company going into the future. The maintainable earnings reflects earnings that will take place in the future. So in reality, other than adjusting for once-off items, you will also adjust your current earnings for any future prospects. Okay, so you will have a look at your earnings. Then you'll say, okay, what are once-off items? Remove it. Then you get to an adjusted earnings figure. Then you look at that adjusted earnings figure and you ask yourself, do we need to adjust it further for based on future assumptions? Okay, so just take note. But for our purposes, we don't still bother with that. We only adjust for once-off items. So we have a number that will most likely recur in the future. You can't leave the once-off items because it will distort the future earnings figure. So just take note of that. So now that we have our earnings figure, we have the value. Okay, so then we get the value. But what's important, that is 100%. Okay, so this is the value at 100%. Then we need to make some adjustments. Okay, so typically you will make two types of adjustments. If you're dealing with an unlisted company, you will make a marketability adjustment. So if you're dealing with an unlisted company, you'll make a marketability adjustment. And then sometimes you'll also make a majority adjustment. They never mentioned it, but generally you must take in a majority. You must make a majority adjustment, but I think it's because when you are using, sometimes they're going to ask you to make the majority adjustments. I'm going to just include it, but we won't necessarily do it. Okay, so we're going to have a marketability adjustment. Marketability adjustment. Okay, remember the adjustment is 15%. It is given. You only make a marketability adjustment if you, I'll explain it when you use it. Okay, you don't always use it. So you will use it when you are dealing with an unlisted entity. You can't pay the same for a listed entity versus an unlisted entity. With a listed entity, there's still some form of liquidity. There's generally going to be some form of liquidity, meaning you can easily sell your shares on a stock exchange. Whereas with a private company, you won't be able to sell your shares easily. So therefore, you want to adjust for that, that risk, basically. Then we get the new value. Then we get a new value also at 100%. Then we're not going to do this, but I'm just going to include it for our purposes, a majority interest adjustment. Majority interest adjustment. Sometimes they will ask you to do this. It will also be about 10%, okay? So remember, a marketability adjustment, you will decrease. It's a negative. It will reduce the value. A majority interest, it will increase the value. Because, we call it a majority interest, a premium. So you're going to pay the company a premium because you're acquiring a majority interest. So generally, that is what companies will charge you a premium because you're buying because you are acquiring a majority interest. So it'll typically be around 10%. Where do we get these percentages? It's not just being sucked out of the thumbs. You can Google. So like typically PwC generally has a report where they analyze M&As, they analyze mergers and acquisitions, and they'll have a look as to what is the value, what is the percentage that companies actually place on a majority interest, what is the percentage that a company actually place on a marketability adjustment. So then they study those transactions and then they come to a range as to what number. That is why that 15% you can most likely Google PwC M&As, right? And then they will talk about these premiums and discounts that will be placed on a valuation. So it's not just sucked out, it is based on some research. Okay, then we get a value which is still 100%. But remember, what are we trying to get? We are trying to get our stake that we need to pay. So what is the value that we need to pay based on what we're going to be paying? So therefore we're going to say value. So here we're going to say 8. So we want 80%. So now we have 100%. We will now work out an 80% majority interest. So that is the structure. So that is the structure basically. We want the value using the PE multiple. So the value using the PE multiple, it is PE multiplied by maintainable earnings. PE multiple. PE multiple multiplied by maintainable earnings is going to give you a raw value. Okay. Then we're going to say, but hang on, this is a private company, so we want to pay a little bit less because of the lack of marketability. So we subtract 15% of that value and we get a new value. Then we say, but okay, we're going to get a majority interest, so we're going to add a majority premium, say 10 to 20%, and you add based on this adjusted value. Then you get a final value. But now you're saying, hang on, we're not acquiring 100%. We only want 80%. We're only acquiring 80%. So what is 80% of the final value? So that is the thought process. Now we can deal. So if you remember, I told you, my brother used for this particular question, actually, he used the template. So basically he had this as a template based on a class we had, and he set up his answer like this. So it was easy for him to do it. He didn't have to remember a format. He used the format that he learned over here, and all he had to do was plug and play. Not really play, but he had to plug and think. Okay, so, but you have to just basically look through the scenario and then work through some numbers. So just, if you understand, if you have a format, you will have it. And remember, almost every valuation has a format. In the real world, there's a format as well, but obviously because of various complications, there will be some differences because of different complications that you may encounter for different companies. But generally, the general look and feel of the valuation will remain the same. Okay. So now we can do the valuation for Form 1. So here I'm going to have workings. So working 1. What we're going to do, we're going to work out the maintainable earnings. Okay, so if we have earnings over here, then we're going to have the year. What is the year? Let me just move this out of the way. So if I have a look at the numbers, so 2015 to 2019, if someone can just help me read out the numbers, 2015 to 2019, 2015, 2016. Okay.
Are we doing farm number 1?
Yeah, so from 2015, what is it?
12,390,
12,390,
12,54,5,
12, like that,
54,5,
okay. Then
12,700,
12,700,
13,220,
13,220.
12,650.
Okay, so there we will, so there we have, okay, so that's given. Now we make the adjustments, okay, once off adjustments, okay. So now we're going to have adjustments. The first adjustment was in 2018. It was after tax profit on sale of patent. Okay, so here we go, after tax profit on sale of patent. So it was in 2018. It was, I cannot remember what was the number now. So the number was 1.4 million. Okay, these amounts in thousands. Okay, so it's 1.4 million. So remember, it was a profit. So what did the profit do? It increased our profit after tax. But we don't want it in our profit figure. We don't want it in our earnings figure. Why not? Because it is a once-off item. So to remove it, we need to subtract it. So 1.4 million. So for example, I'm going to put in 1.4 million, 140, 123. But remember, I need to divide by 1,000, so I need the amount in rand thousands, because the top number is in rand thousands, so this must also be in rand thousands. So 2018, in order to remove the profit, we subtract. Why? Included in the profit, in the earnings figure, is this profit. This profit on sale increased our earnings figure. We don't want it in the earnings figure, so to remove it, we decrease it. Okay. Then we have restraint of trade in 2016. Restraint, what's called? It is, where is that now? For restraint of trade. Restraint of trade. Okay. So for the restraint of trade, it is sitting in the 2016 number 1.3 million. Okay, so 1.35 million. So remember, included in the earnings is this restraint of trade payment. That is an expense. So what did it do? It reduced the 2016 earnings figure. So to remove it, we need to add it back. So 135 million divided by 1,000, because all the numbers is in rand thousand, so therefore it's 1,350. But now remember, this is a before tax amount, so we need to take an after tax amount. So tax on restraint of trade So you just be the opposite of that. We can take the corporate tax rate of 28%. So there we go. I'm just going to leave a space. I leave a space just in case there's another number we missed, but I don't see any numbers. So that there we go. So here we have adjusted earnings. So when we get the adjusted earnings, we're going to add up. Now we can see 12 million, 13 million, 12 million, 11 million, 12 million. Erratic. Therefore, we cannot use the latest year. So you will say the adjusted earnings is erratic and hence has no trend. Therefore, the maintainable earnings figure, therefore the maintainable earnings figure will be a weighted average. Okay, so it will be a weighted average. So just take note of that. So if there was a trend, let's say from 2015 right through to 2019, each year it increased, or from 2015 right through to 2019, each year it decreased. There's a trend of an increase or there's a trend of a decrease, then you will use the latest number, 2019. You'd have used this 12650. But because there's no trend, there's no only upward increase or downward decrease, it is erratic. 1 year's up, 1 year's down. Okay, so there's no consistent trend. That means the earnings is erratic, so we use a weighted average. Okay, so the so maintainable earnings is therefore maintainable earnings is. So now we will work out the number. Okay, so to get a weighted average, we will basically just put we will just make it 1, 2, 3, 4, 5. Okay, so you start with 1 from the earliest year and you just go 2, 3, 4 up until the latest year. So that is what we're doing over here. Okay, we're just putting a weight to it. So to convert this into an actual percentage, we get the total. So the total over here is going to be whatever the total is, 15. So the percentage over here is going to equal that divided by the total. Okay, so now we will be able to work out the maintainable earnings. So you're just basically going to say that multiplied by the weighting. And I will drag it across. So now the total is the sum of all of these. So as you can see, it's in the range of the yearly figures, but on a different weighting style. So therefore, the maintainable earnings is equal to 12,537. I saw a message in the chat. No problem, you can leave. So that is basically the maintainable earnings number. Okay, so now we can go and plug this in. So if I go to maintainable earnings, it is equal to the 1253. So remember how, just have a look how it is the weighting. Okay, very important. So we're using a weighted average. Why? Because it is erratic. If it was a consistent trend, we'd have used the latest number. We'd have used the 2019 number. Okay, so now I have that. I will tell them working one. Once again, if you have a format, you just basically plug in the numbers once you have your format. So just like pay attention to these, as those small differences that make a significant impact on the final result. Having these formats is going to make your life easier. Okay. Now we're going to do the PE multiple. They never gave us a PE multiple. They gave us an earnings yield. Okay. They never gave us a PE multiple. They gave us an earnings yield. The earnings yield is an inverse of a PE multiple. So therefore, we can convert the earnings yield into the PE multiple. How did I get the 826? It is basically the earnings of the adjusted earnings of 2015 multiplied by the weighting of 2015. How did I get the weighting of 2015? It is basically, we allocate a number, a 1 out of the total weighting of 15. So how do we just do this? You just go 1, 2, 3, 4, 5 up until the last year. And this 15 is the sum of all of that. So therefore, 1 divided by 15 will give you a weighting of 7%. So therefore, 12 times 7% will give me 826. Do that the same for each year. Then you sum up all of that to give you the average of 12,537. We'll see, try to find the chat. Where's this chat? Okay, I don't know why I can't pick up the chat. I'll check the chat just now. I'll just ask Bakado for some other reasons not picking up the chat. So now I'm going to go into the PE multiple. Remember, they never gave us a PE multiple, but they did give us an earnings yield. Okay, the earnings yield would be as a result of the earnings yield is basically the inverse of the PE multiple. So what we're going to do is as follows. We're going to start off comparable earnings yield. Okay, comparable earnings yield. So the comparable earnings yield was given to us as 16.25%. Let me just check if that is correct. The comparable earnings yield, yes, 16.25%. Okay, so that was given. Now we can just convert to PE, because they're not telling us to use earnings yield. Okay, earnings yield, PE multiple, the same thing. PE multiple is easy to understand, so therefore we just convert the earnings yield into PE multiple. Or alternatively, you can just use the earnings yield if you are comfortable with it. I just like to convert the earnings yield to a PE multiple, unless they tell me use earnings yield. So convert to PE multiple. So the way you're going to do this is basically equal to 1 divided by, so therefore the earnings yield, the PE multiple is 6.15. Okay, so remember, earnings yield equals 1 divided by PE. So I rearrange the equation. So if I rearrange the equation, PE equals 1 divided by EY. Okay, so just remember, now I have a convert to comparable PE. Okay, so now I have a comparable PE multiple. So now this is my starting point. This is my starting point. Okay, my comparable PE is my starting point. Remember, I'm putting comparable PE. It's not the PE of Farm 1. This is a PE of a comparable company in the dairy industry. So what we're going to do, we are now going to convert this. We're going to take the comparable PE and convert it, adjust it to be a PE of the target company, a PE of Farm 1. How do we do that? We adjust for differences between Farm 1 and we adjust for differences between Farm 1 and the comparable PE. Okay, so let's have a look. If we go back to the scenario will tell you what adjustments you need to make without being direct. Okay, so you can have a look over here. It says Farm 1 provides top quality, innovative dairy products. Okay, so here that is a difference from Farm 1 to the industry. So innovative products, that is a difference. Innovative, top quality products. That is one difference between the industry and Farm 1. Okay, so top quality, innovative products. Okay, then they also do business in an environment-friendly manner. Okay, conduct, that's a difference. Conduct business. Remember, being environmentally friendly adds value to a company. Nowadays, many companies want to only transact, do business with other companies that are environmentally friendly. Okay, conduct business. Okay, just to make it simpler, environmentally friendly business conduct. Okay, that is a difference between, that is what's making them attractive, that they environmentally friendly. Okay, we got that. The competition is rife in the dairy farm industry. Okay, so what's important? You must only take into account things that is different between the comparable PE and that of the target company. You must not make adjustments for things that are general within the industry. So we're not going to make adjustment for competition, because that is general within the industry. They say the competition is rife in the dairy farm product industry, so it's applicable to all the dairy product farms. Okay, so it's not specific. It's not specific to this farm. Okay, where top quality innovative products is not necessarily general within the entire industry. It is specific to Farm 1. Environmentally, business conduct is specific to Farm 1. But the competition is general. It is applicable to all. So we don't adjust for competition. Then they say, and companies like Farm 1 struggle to penetrate the market due to limited distribution network and high marketing and branding costs. So that is specific to Farm 1. So therefore we can have, what was it now? Limited distribution. Remember, limited distribution means you are unable to sell a lot. Okay, your distribution is so limited that you can't increase your sales revenue. The better your distribution network, the more revenue you can earn. So that impacts the value of the company. Distribution. If you have a look at innovative quality products, that will impact the value of the company. Because innovation generally means that it reduces your cost, and then top quality, you can charge a premium. Okay, so you most likely can benefit from that. Higher prices, better lower costs. Okay, environmentally friendly, as we know, as I said, mentioned that many companies only want to do business with environmentally friendly companies. So that's very important. So it's going to impact your revenue. It's going to impact your business relationships. So it does have a value. Limited distribution, as I mentioned, the better your distribution network, the more customers you can reach. As a result, the more revenue you can earn. Then high marketing and branding costs. So why that? Why remember, if you incur high marketing costs, even though you're making more revenue, it's still going to reduce your value. Why? You spend you're earning revenue, but your marketing cost is higher than normal. So your net profit is going to be lower. So as a result, that's a negative impact. Okay, I'm just mentioning a few things. I mean, there's probably more that you can say. Nonetheless, high margins and relatively low production costs results in good profits for most dairy farming products. Okay, that seems general to the industry. So therefore, that's all. Now, all you have to do is put a plus or a minus. Remember, you need to ask yourself, is this going to increase the value or is it going to decrease the value? If it's going to increase the value, you're going to put a plus because it's going to make the PE multiple bigger. The bigger the PE multiple, the bigger the value. Because just look at the formula. It says PE multiple times maintainable earnings. So let's assume maintainable earnings is 1,000 Rand. So if the PE multiple is 2, your value is going to be 2,000 Rand. But if the PE multiple is bigger, if it is 3, then your value is going to be 3,000 Rand. So therefore, if the differences will increase the value of the company, you will make a plus to increase the PE. If it is a negative impact on the value, you will make it a minus. So as you can see, innovative products, we expect that to be a positive impact on value, so we make it a plus. Environmentally friendly business conduct, that will have a positive impact on the business, so therefore we make it a plus. Limited distribution, that has a negative impact on the value, so therefore we make it a minus. High marketing costs, we also make it a minus, but that will have a negative impact. Now we can see there's pluses and minuses, and now we can make up a number. Okay, you make up a number. This number, keep it between 3 to 5. So you either add 3 or between 3 and 5, or you subtract 3 and 5 based on what you made mention over here. So it doesn't mean we have 2 pluses, we have 2 minuses. It's not going to have an impact. Remember, each plus does not necessarily carry 1. Some pluses is 2, some pluses is 3, some pluses is whatever. It doesn't mean this is 1, that is 1, that is 1, that is 1. Doesn't mean that. It depends on the actual adjustment. Okay, so you need to give whatever number you want to, but we don't have to give a number. We just put plus and minus. That's all that they mark. All that they're marking is a plus and a minus, and then you put a final number. So what we can do, we can maybe let's say a plus 2. Let's just say a plus 2. So therefore we come to 8.15. I made this up. Okay, you make your one also up. So we get, what you can just do, you can just make, I'm just going to make it 8. That's all I'm going to do, because I'm saying my pluses outweigh my negatives. So therefore I'm making it a higher. Okay, you can make it lower, does not matter. Okay, does not matter. So there we go. Or actually, let's make it lower because distribution network is important. So let's make it lower. So I'm making it 5. Okay, so my PE multiple. So there we go. Adjusted PE multiple. You make up a number. You could have added, you could have said you think that innovative products plus environmentally business conduct has a bigger weighting. But if you look at, but I'm saying now limited distribution has a bigger weighting, because a limited distribution means less customers, means less revenue. Whether you have an innovative product or not, if you're not reaching your customers, you can't make money. So therefore, I'm saying the limited distribution has a higher weighting. So therefore, I'm going to say it is going to be less than the comparable company PE. So I'll give it 5. So now all I do is I go plug in over here. I'm saying over here it is working 2 and it is 5. Where did I get 5? So there we go. So now I can say my value is PE multiple times that times the maintainable earnings. So I got, that is my price over here. Then we need to make a marketability adjustment. So remember, marketability adjustment, there's going to be a negative impact on the value. Why? Because it is so it's a negative impact on the value. Why? Because you can't easily sell. Okay, so I'm going to say negative, which is a negative impact, that times 15%. So my new value will be the sum. But we're acquiring a majority interest. Okay, we're acquiring majority interest. So I'm going to say 20% premium for a majority interest. So you must add a majority interest premium interest. Okay, so we add a majority in premium. So I'm going to say that multiplied by 20%. And then we get a new final value. So now the final value is that. But remember, we don't want 100%. We're only acquiring 80%. So therefore, I'm going to say final value times 80%. So that is the value you will attach to the 80% interest for Form 1. Okay, so you can just conclude. So if you read the required is saying, what is the required saying? Use the most suitable valuation method to determine the values. Okay, so there we determined the value. So we can stop right there. So there we determine the value, done. Okay, now I'm going to do Form 2. For Form 2, we're going to do a free cash flow method. For Form 2, we do a free cash flow method. The way you do it for free, using the free cash flow, is setting up a cash flow table. So how do we do this cash flow table? So the cash flow table will look as follows. Details, and we put the number, and we have here 0. So we put in the details and then here 0. Remember here 0, if I just actually do this, the reference point is 31 March 2020. So year 0 will be your reference point. Then we have 3 years of information. We have 3 years of information. Where was that? 2020 forecasting growth in the company's profits for the 2020 financial year, 2021 financial year, and 2022 financial year. So our reference point is, so it's going 31 March 2021. So that is our reference points. Okay, so that's what we will be doing. Now this is 1, 2. So that's what we will be doing. So all we're going to do now is work out our earnings. But remember, we want cash flows. So we want earnings. Then we're going to subtract depreciation, add I'll explain why we add depreciation. And that will give us our free cash flow. This will give us our free cash flow. Then we add back give us operating cash flow. Then we will add something known as your terminal value. I'll explain this now. Terminal value, and then this will give us our free cash flow. Then this will give us our free cash flow. But remember, we don't want cash flows for every year. We want a value today. So to get a value today, to get a present value, we need to discount future cash flows using an appropriate discount rate. The appropriate discount rate is WACC, okay, or your required rate of return. Your appropriate discount rate is WACC. So the appropriate discount rate is WACC, and that will give us our value. This will give you value 100%. Okay. Then once again, majority interest premium, and that will give us our final value. Then there was no marketability issue over here, so it's fine. And we get final value. Once we have the final value, we will then be able to work out, okay, the value of a 67% interest. Okay, so value of a 67% majority interest. So that is basically how we're going to do it. So now the thing what we need to do is to actually get the earnings number. Okay, so let's go and work it out. So here we're going to put in earnings. We're going to have working 3. So to get the earnings, we're going to work with working 3. So if we have working 3, we're going to have details. We're going to have 2019, 2020 through to 2022. So let's have a look. The earnings was as follows. The earnings in 2019 was 3250. Okay, so the net profit 3250. So 3250, also in rand thousands. So we will start off over here. Growth. So the growth rate, nothing in 2019 because we have 2019 already. In 2020, it is 7.5% increase. In 2021, 8. In 2022, 8.5. 8%, and then 8.5%. Okay. Then we're going to have the earnings. So the earnings was given in 23250. Now we're going to have to grow it by the growth rate, which is going to be 2019 multiplied by 1 plus the growth rate. Because you remember, if you think about the dividend growth model, if you remember WACC, when we dealt with a dividend growth model, we wanted D1. If we were given D0, the most recent dividends, how did we get D1? D1 equals D0 multiplied by 1 plus the growth rate. So same thing over here. We want the earnings of next year. So we say the earnings of 2019 sorry, so if we want the earnings of next year, which is earnings of 2020, we're saying earnings of 2020 equals the earnings of 2019 multiplied by 1 plus the growth rate. So if you have a look, we're saying the earnings of 2019 multiplied by 1 plus a growth rate of 7.5%. We apply the same for every year. If you have a look, that is going to be the earnings of 2020 multiplied by the growth rate of 2021. Similarly, over here, it is going to be the earnings of 2021 multiplied by the growth rate of 2022. Okay, so just take note of that. So there we have our earnings figures. So now all we have to do is go and plug it in. So this is D57. So if I go to my, my actual cash flow, I'm going to say equal D57, no, sorry, not D57, E57. So remember, we don't take 2020 into account because our reference point is 2020. So 2020 is year 0. So we don't take year 0 into account. We only take future years. But we needed to start with 2019 in order to get to 2021 because we did not know what was 2020's earnings figure. Oh, sorry, I put it in the wrong place. Equals E57. And we do the same, drag it across. Now, included in this earnings figure is depreciation. Depreciation is a non-cash flow number, and therefore we need to remove it. We don't want non-cash flows because we're trying to go from a profit figure to a cash flow figure. So therefore, in any non-cash flow number included in the profit must be removed. Now, depreciation is a non-cash flow figure. Depreciation is an expense. What did the expense do to profit? It reduced profit. So to remove it, you add back depreciation. Depreciation was given us as 250,000. But remember, the numbers are in rand thousands. So therefore, I need to divide by 1,000. So all I'm going to do is add up. Okay, now we must work out the terminal value. What is the terminal value? In a free cash flow calculation, there's two parts. There is the explicit period, and then there is the terminal value, or another term they use, the continuing value. So you have two parts in a free cash flow, the explicit period and the terminal value or the continuing value. The explicit period, this is the explicit period, where you have specific columns for specific information. That is known as the explicit period. Technically speaking, you want the explicit period to be 10 to 15 years. That is why in the real world, they hardly use the free cash flow method. Sorry, quickly. So that is why in the real world, they hardly use the free cash flow method because the forecasting is for 10 to 15 years and hardly anyone can forecast that accurately for so long. So therefore, there's a high forecast risk in the free cash flow. But here we only have 2 years, okay? So the explicit period is basically, so how long is the explicit period? You try to get it 10 to 15 years, but basically as long as possible where you can get the most accurate information. If you can determine information accurately for as long as possible, that is how long explicit period must be. Once beyond that point, then you just work out the terminal value or the continuing value. So they are saying, so they are saying we can only work out information. We can only work out information. Sorry, quickly. So the same, we only have specific information for a period of 2 years. Therefore, our explicit period is 2 years. So now we'll work out the continuing value. Now, what I want you to pay close attention, the continuing value is very similar to the dividend growth model. Okay, you're going to see the formula is the same, but the inputs are different. So the similarity is that the formula is the same. The difference is the inputs are different. And you must be able to contrast that. Why this is important is because if they give you a scenario, then you must be able to analyze, pick up any errors. So you must be able to pick up the errors if they use the wrong information. So just pay careful attention. So let's work out the continuing value. Where is this terminal value? Over here. So working for. So let's have a look. So for working for, so this is the formula. So the formula, the value at year 2. So remember the value at year 2 equals free cash flow of year 3 divided by WACC minus the growth rate. Now just for one moment, let's contrast the dividend growth model. If you had to work out the dividend growth model, it'll look like something like this. Typically what we used to, V0, the value today, equals D1 divided by KE minus G. So let's look at the similarities. They both have a cash flow figure, but what's the difference? In the free cash flow, we're using the free cash flow and not dividends. Whereas in the dividend model, we use dividends as the cash flow. Then in the denominator, it is a discount rate minus growth. So they're both using growth, but in the free cash flow, the discount rate is WACC. Whereas in the dividend growth model, the discount rate is the cost of equity. Why I'm bringing this to your attention, you need to see the similarities, you need to see the differences. And more importantly, if they give you a question, if they give you a free cash flow and you must critically evaluate, they will most likely calculate the terminal value using information of the dividend growth model. And they want to be able to see whether you can pick up, if you can spot those errors. So keep in mind, it's very similar, but what's the two differences? The discount rate in free cash flow is WACC, where the discount rate in the dividend growth model is cost of equity. The second difference is that the cash flow in the free cash flow calculation is the free cash flow, whereas the cash flow in the dividend growth model is the dividends. So just pay careful attention to that. Okay. So let's work it out. So we want the value. We want the value in year 2. We want the free cash flow of year 3. We need WACC, which is the required rate of return, and we need the growth rate. Just pay careful attention. You can see I'm taking value of year 2. We're going to plug in the value. We're going to plug in the value over here. I'm highlighting it in orange. We will plug the value over there. Yet the cash flow that we are using is the cash flow of year 3. Why? When you work out a present value, the present value falls into the year before. Like the same thing over here, we're working out the future value of year 1 and year 2. Where do we plug in the present value of these future cash flows? We plug it in to year 3, into year 0. So just take note of that. The future cash flows fall into the period before. So since the cash flow is starting from year 3, the present value falls into year 2. So just keep that in mind. Because remember, we are working out the present value at the beginning of year 3. We are working out the present value of the future cash flows from year 3 onwards. So take note, that formula is taking all the cash flows from year 3 up until the end of time. And we're getting a present value at the beginning of year 3. Now, if you remember capital budgeting, we said in capital budgeting, each column represents the end of the year. So we can't put the present value in year 3 because year 3 represents the end of year 3, where that present value represents the beginning of year 3. So where do you put something that represents the beginning of the year? You put it in the previous column. So just take note of that. The timing of cash flows is extremely important. Okay, so very, very important. They're going to test you on that also. What they may do is that they use the wrong cash flow. What they may do, they use the wrong discount rate. But what they may also do is plug that number maybe in year 1 or in year 0, or plug it in year 3, but it should actually be in year 2. So just be aware of that. Remember, the present value of the cash flows that you use is going to bring the cash flows to the beginning of that year. So we're using the cash flows from year 3 up until the end of time. So therefore, the present value is going to represent all the cash flows as at the beginning of year 3. So why can't we put it into year 3? Because the column of year 3 represents the end of year 3. So therefore, in order to get it to the correct column, we put it into year 2, because the end of year 2 represents the beginning of year 3. So let's go and calculate it. So we know the free cash flow is sitting over here. It is E18. So if I go plug it in, it is equal to so let's quickly do this. So E18, so remember, free cash flow year 3 equals free cash flow year 2 multiplied by 1 plus the growth rate. Okay, so it is going to be E18 multiplied by 1 plus the growth rate. Okay, so we need to go find the growth rate. So let's have a look. The growth rate was given to us as, so here they say, the growth rate after 2022 will be at 5% and the required rate of return 17.25%. So the growth rate is 5% given. Required rate of return is 17.25% given. Okay. So now I can work out the value. The value equals free cash flow 3 divided by WACC minus the growth rate. So what do we notice? There we go. The value is 37 million. So I go right to the top. It will equal C80, what C, I think it was C37. Nope. There we go. So there we go. There's the cash flows. Now we can add up. The discount rate is the WACC, which is 17.25%. Now I can work out the value. So using Excel, I use the NPV formula. It asked me for the rate, it asked me for value 1, it asked me for value 2. So my value is 33, it is 33 million. It is now majority interest, only 67%. So majority premium of 50. So between 10 and so it's basically between 10 and 20%, because 67, make it a 15% interest. So 15% premium, sorry. So we're going to say that multiplied by 15%, get a new value. And now we want 67%. So we're going to say multiply by 2 divided by 3. So basically, that is how I would do it. We don't have the solution. So remember, in the valuation question, you're hardly going to get 100% exactly to their solution. They will just have a look at your assumptions. You're not going to get 100%. Don't expect to be 100% their number. Don't expect to just look at the final answer and start panicking when it doesn't equal their number. You need to have a look and work through how they got to their number and see whether things that does not have assumptions is correct, and the only difference is as the result of the assumptions that you are using. So just keep that in mind. Okay, that's all that I wanted to cover for tonight. You can ask me if you have any questions. I see you something in the chat. Let's just have a look. Let's see why I can't pick up the chat. Okay. Okay. Okay, so there we go. Okay, so okay, so there we go. So just keep that in mind. Okay, so that is basically. Is there any other questions that you guys have? So Kayla, on your question for that's just how they do the weighting. That's just a simple way of doing the weighting. So you asking in terms of why don't we do it? Where is it now? So you want to say add up that sum and then do a weighting like that. I guess you can do that, but they just follow this weighting approach where they allocate with one for was 5 years ago, and so they want to give a higher weighting for the latest years and a lower weighting for the earlier years. But I guess another appropriate way would be the other way. But this is a typical way that you need. So follow it. If you read the textbook, they will follow that approach. They want to give a lower weighting for earlier years and a higher weighting for later years. That is the reason why they they provide a number like this, as opposed to working out the weighting as a percentage of the total. Because then it's just basically going to become an average, a normal average, and that's what they don't want. Okay, so just take that. So Danelle asks, she's getting 867. Remember, I'm using Excel. So when you take 1290 multiplied by 0.07, you're going to get a different answer. Excel is running into millions of decimals. So that is why there's going to be a rounding difference. So don't stress about those rounding differences. Okay, do you guys have any questions? I hope you got the feel of the thought process. So it's very important to understand the valuation methods available to you, when to use them, and how to calculate them in general. Okay, what's a general format? And then using the specific scenario to maneuver the actual format. Okay, so it's not going to be 100% exact same format every time, but to a large scale, that is how the format will look. The more important thing is, I hope you got the rationale and the understanding. Is there any question that you guys have? Let's just see. Fahim, Kayla, any questions?
Yeah, Faiz, my question was, why don't we calculate anything in year 2020 for Form 2?
Say again?
Why don't we calculate anything in the year 2020 for Form 2?
For Form 2, okay. They asked you for your reference point to be 31 March 2020. So if your reference point is 31 March 2020, it means year 0 is 2020. As a result, year 0 have no information because year 0 is now. You're looking into the future. If they said calculate a value at 31 March 2019, then 2019 is your reference point. 2019 is year 0. 2019 is now. Then you work into the future, which will be 2020, 2021, 2022. In this scenario specifically, that is how they're testing you on your timing. So remember when we did capital budgeting, there was 5 principles of capital budgeting, but a lot of those 5 principles applies throughout financial management. And one of those was one of those 5 principles was or were the timing of cash flows. So same thing over here. They want to see whether you know how to deal with the timing of cash flows. They specifically gave you information. They gave you a balance sheet at 2019, and they gave you figures 2020, 2021, 2022. But the scenario didn't say let your reference point be 2019. The scenario said let your reference point be 2020. So as a result, that is basically how it is impacted. Okay, so just take note of that. Okay, Kayla. Kayla, any questions? Kelsey, Bongani. Prashini, any questions? Okay,
I
Kayla.
do think I'm gonna watch this over again.
Okay. Okay. Kelsey.
I just wanted to know the premium that you use, the percentage, is it at our discretion?
Yeah.
That okay.
Your discretion, it just needs to be reasonable. So for a discount, a marketability discount, we use 15% because they gave us, but it will generally be between 5 and 15%. So they don't give you, use any number between 5 and 15. For the premium, it is between 10 and 20%. So use any number between 10 and 20%. So in form 1, I use 20% because they're acquiring an 80% interest. In form 2, I use 15% because they're acquiring only a 67% interest. So like I said, in the PwC, if you Google PwC merger and acquisition premium and discounts, something will most likely come up, then they'll give you ranges over there. Okay, so not just thumbs up, they are real ranges based on what they done real research on. Masina, Bongani.
Yes, mine it's based on the value 100 after you consider the discounted rate of work. So I didn't catch up correctly there.
Say again. For form 2.
Farm 2.
Okay. So for form 2, where is that now? So you're talking about this over here, the value of 100.
Yes.
Okay, so what about it?
I did the value. When I try to calculate it, I don't get it. It did 3675.
What do you get?
I'm getting a 71,722.
How do you get that?
You take the 41578 multiplied by 7.25, or you add both 2021 and 2022.
Now, so you must use your financial calculator.
Okay.
And you must use a cash flow function on your financial calculator.
Oh.
Okay. So you can message me separately, then I'll show you how to do it, depending which financial calculator you have. Do you have the HP?
Yeah, do you have any question?
Yeah, okay. You can message me separately, and I'll show you how to use it on the financial calculator. You want to get exactly this number, or get close to this number, because I'm using Excel. Excel runs into millions of decimals, where the financial calculator will either run to 2 decimals or 4 decimals, depending how you set your calculator. Okay.
Okay.
Prashni, anything from your side? Okay, that's all good. Okay. So your homework for the next 2 weeks is so what we'll do some more valuation questions. So this is the first one. The nice thing, what I liked about this, it covered both free cash flows and it covered PE. So now you can use this video and re-watch it so as a basis for your other calculations. Okay, so just take note of that. So you can use it as a basis for your other calculations, your other valuation calculations. As you do some more questions, we'll cover the net asset value method. That's 5 marks max, so nothing to stress about. But PE, free cash flow, is going to be quite big. So your homework, but I'll send in an email as well. Question 2.1, calculate WACC. Okay, 20 marks. And then from question 1, I want you to do required 1 of question 1. So this 20 marker and whatever this adds up to. So this is financial analysis. So send it to me. I'll mark it. I'm starting to mark your other ones this weekend and so forth, and I'll provide you guys feedback. Okay, that's all from me, from my side, guys. I'll see you in 2 weeks' time. So try to rewatch this video because this is now a good basis to do other valuation questions. It's not going to be 100% the same, but like 90% is going to be the same. Okay, so then just try to navigate yourself through questions.
So, Rufus,
Yeah,
where do we get the recordings of the videos?
I will email it to you guys. I haven't uploaded it yet. So once I upload it, I'll probably upload it this weekend as well. Okay. So what I'll do is, so I send an email out with the recordings. You should have up until week 4 or week 5. I just need to check the last email, but I'm also uploading it on the platform. So you will see there's going to be a heading called weekly Zoom recordings, and then I'll list it over there. Okay. Okay, guys, I'll see you guys. All the best. I'll send an email to remind you about these questions so that I can, in that way I'm able to pick up any gaps and so forth. Okay, see you guys. Bye bye.